I'm Christy Campbell, co-founder and COO of iUgo. As promised in our previous video covering exemptions, we are ready to talk about child tax credits. Now, unless you have children younger than age 17, this video isn't for you. So let's take a look at the changes. The first change is the amount of the child tax credit that increased from its original amount of $1,000 to $2,000 per qualifying child. The refundable part of the child tax credit, known as the additional child tax credit, also increased from its original amount of up to $1,000 to up to $1,400 per qualifying child. Let's look at an example. Chris and Virginia are married filing jointly with one qualifying child. This means that they have a child tax credit of $2,000. However, they claim the wrong number of allowances for their family size and underpay their taxes, now owing $500 in taxes. The child tax credit reduces their tax liability to $0 and leaves $1,500 extra. However, the additional child tax credit says you can only receive up to $1,400 per qualifying child, so Chris and Virginia will receive $1,400 in credit, not the $1,500. The second change has to do with Maggie. No, not your cousin Maggie, but the modified adjusted gross income. What does this mean? In the previous law, married couples filing jointly had a phase-out income limit of $110,000, meaning that once you hit the amount, the credit began to phase out. Under the new law, the phase-out income limit has increased to $400,000. The third and final change for child tax credits is the requirement for the qualifying child to have a Social Security number that allows them to work in the United States. Before this change, children with ITIN numbers that resided in the United States could take the credit, but under the new law, they cannot. Hopefully this has been simple to understand, but if not, please leave your comments and we'll be happy to answer any questions you may have. And more importantly, stay tuned for the next video.